Right, this is my audience. Okay. Don't you wish there was a way to prevent fraud or errors from occurring on financial statements? Well, there is, and they are called internal controls. One of my main sources, Will Kennan, defines internal controls as mechanisms, rules, and procedures implemented by a company in order to ensure the integrity of financial and accounting information, as well as to promote accountability and prevent fraud. There are two types of controls: preventive controls, which are set in advance in order to prevent fraud or errors from occurring, and detective controls that help catch fraud and errors that preventive controls might have missed. Emma, another source of mine, explains the big cases of fraud that occurred with two of the world's biggest companies, Enron and WorldCom. Enron and WorldCom lied on their financial statements and overstated assets by billions when they should have all been recorded as expenses. This made stockholders think that their net income was way higher than it really was, and many stockholders who invested lost their money. That's why some of the preventive controls that companies follow is separation of duty, making sure the employee who is handling the asset isn't the same one recording the asset. Another preventive control is making sure that all transactions are officially approved by the CEO and recorded accurately. These procedures are set up to reduce the risk of losing assets, as well as making sure all companies' objectives are carried out in the right way. Detective controls consist of bank reconciliations, which means the company constantly compares their bank statements with their company statements, making sure that all assets and liabilities are the same on both statements. Another important control is monitoring, to make sure everyone is following the procedures. The information found as a result of monitoring is used to report an analysis of progress, pointing out the weaknesses that are in need of management help. In conclusion, internal controls and risk management are essential in running an efficient accounting firm. Not only do they cause companies to run honestly, but they also help achieve operational, strategic, and reporting objectives. Thank you.